Okay, so we are finally on to the second half of the cheat sheet, and what we're going to be focusing on now is the CVP. So CVP encompasses this entire section. However, it can also be broken up into these two sections. So right now we're just going to focus on this one. And I'm probably going to make more videos than I originally thought because I didn't realize how long each section would take. So, okay, to start off with CVP, you need to understand what we're doing here to begin with. So initially normally we have the GAAP income statement, which is revenue minus your cost of goods sold, which gives you your gross margin, and then you subtract your SG&A, which gives you your operating profit. Okay, so just a refresher on the first exam, all costs are made up both of variable costs and fixed costs. So these cost of goods sold and SG&A both have variable costs and fixed costs in them. So now we're on to the contribution margin statement. We're going to start with revenue again, so we're just going to drag that over. But this time, instead of taking off our cost of goods sold, we're simply going to take off our variable costs. And this is all of our variable costs. So we're going to take the variable costs from our cost of goods sold, and we want to take our variable costs from our SG&A. So once we take those off, instead of getting our gross margin, we're going to get our contribution margin. So then after we get our contribution margin, instead of taking off SG&A, we're just going to take off our fixed cost. And that's the total from cost of goods sold and from SG&A. So then in total, we're going to end up with our same exact operating profit. Now, one thing to note here is that because our revenue and operating profit are the same, the only thing that changes are how we distribute the costs. And therefore, instead of getting a gross margin, we get a contribution margin. Now, we do this because we specifically want the contribution margin and fixed costs because we can plug those two variables into this enormous list of equations to get a bunch of answers for some questions we have. So we're going to kind of dive into that. So this is kind of just a list of equations, and I'll kind of work through them, and hopefully they'll make sense, and then we'll practice a problem. So the first equation is just your contribution margin per unit. That's just your revenue per unit minus your variable cost per unit. And so that's kind of shown here. Contribution margin equals revenue minus variable cost. Your contribution margin ratio is just your contribution margin that you found above divided by your revenue or your sales. So the contribution margin ratio is the same thing as a contribution margin percent. So now we get on to some real equations. So the break-even point, and this is not including tax, but if they ask you for the number of units you need to sell in order to break even, that's break-even quantity, will just equal your fixed costs, that's your total fixed costs, divided by your contribution margin per unit. So this is a total. And then your break-even quantity revenue, so the amount of revenue you need to earn in order to break even will equal your fixed cost, which is again total, divided by your contribution margin ratio, or percent. And then if they ask you for break-even point with tax, you can just plug them into this equation, plug all these variables in. I haven't actually seen any questions asked for this, so I don't really think it will be on the exam, but it's here just in case. So next you have these two questions which are called target profits. So you have the target profit without tax. So this is a question disregarding tax. And you have target profit with tax. And these are all equations on how to find generally what revenue you need to sell in order to hit these target profits. So in these questions it may say we want a target profit of $600 $600,000. How much revenue would you need to sell? So in this first equation, it says the revenue required pre-tax will just equal your fixed costs. So your fixed costs plus your target profit divided by your contribution margin ratio. Now, sometimes they won't tell you that they want a $600,000 target profit, but instead they'll say we want maybe like a 10% return on sales. And that basically means that for every dollar they make in revenue, they want 10 cents return in profit. So to figure that out, to figure out how much revenue you need to make in order to hit that return on sales, you just find required revenue equals your fixed costs divided by your contribution margin ratio minus your return on sales ratio. So that'll be your fixed costs divided by your CM percent minus whatever percent they give you. So like your return on sales ratio. And that may be like 0.5 minus that 0.1 like we just said. Now, finally, if they ask you for the units you need to make in order to hit that target profit, you're just going to take one of the required revenues that you already found and divide that by the price per unit. And that'll give you the number of units you need to sell. So, target profit with tax. So these questions will say, including tax, how much revenue do we need to sell to get this target profit? And they're basically the same thing, except this time you can do required revenue post-tax, and that's just your fixed costs plus your target profit divided by 1 minus the tax percent, and all of that divided by the CM ratio. So for this 1 minus the tax percent, if the tax percent is 7%, then it'll just be 1 minus 0.07. Okay, and then same thing for the units. You just divide the required revenue by the price per unit. Okay, now this next equation is for margin of safety. So a margin of safety is this. Let's say you're at a company and you guys earn $150,000 in revenue, and your break-even point is $100,000. So that's break-even. Your margin of safety would therefore be $50,000. Or in other words, dollars. So in other words, you can stand to lose $50,000 before you start to go past your break-even point and you start to actually lose money. So that's how we view margin of safety. How much money can you lose in revenue before you start to lose a profit? So that's margin of safety revenue. If you asked it in units, then it would just be 150 units. And then say your margin of safety, your break-even units is 100 units. Your break-even units would just be 50 units. And now if I ask you for percent, then if we know 150 is our units or our revenue, then that's 100% of our revenue. And then if our break-even point is this, that's, I don't know, that would be 66.6 repeating percent. So therefore, if this is our revenue and this is our margin of safety, we know that we can stand to lose 33.3 repeating percent of our revenue before we start to go into the negatives in profit. So that I might have lost you there at the very end. However, the formulas are relatively simple, and as long as you can apply them, then you should be fine. So if I ask you for the margin of safety revenue, you're just going to take the planned revenue minus your break-even revenue. Margin of safety quantity equals planned units minus break-even units, and margin of safety percent just equals one of the ones you found above divided by their planned revenue if you're using revenue, or planned units if you're using units. Okay, so degree of operating leverage is our last question we're going to work on. Last equation. This one's kind of trickier to explain, so I'll kind of draw it out. Let's say you are at a board meeting, and there is a guy presenting at the front, and he says to your CEO, our revenue went up by 10%. And everybody's cheering and everybody's happy. And then this guy who barely pays attention and you're not sure how he got into your company goes, oh my God, that's awesome. Great news to hear that our operating profit went up by 10%. And you, being the smart managerial accounting student that you are going to look at him really wide-eyed and look at everybody else and say, did he really just say that? Because obviously, if your revenue goes up 10%, that does not mean your operating profit will also go up 10%. So degree of operating leverage is basically a way to figure out, okay, so if revenue went up 10%, then how much would operating profit go? Would it go up or would it go down? And by how much? What percent? So that's what degree of operating leverage is for. So to do that, we simply just have to take the contribution margin, and that can be either per unit or the total contribution margin, divided by your operating profit. And if you do per unit contribution margin, you have to do per unit operating profit. And if you do total contribution margin, you have to do total operating profit. So I list down here, if degree of operating leverage is 3.85 and your sales increases by 10%, like we said, then we would know, you, the smart math student, would say, okay, our operating profit would thereby change by 38.5%. In other words, that 3.85 degree of operating leverage times that 10%. So that's kind of how you can find the relationship. Now, some people may be confused as to why, if sales increases by a certain percent, how come operating profit would increase by a much larger percent? And that can quickly be drawn out like this. Imagine you make $10 in revenue, and your break even is, I'm gonna do this. Your break even is $9 in revenue. So therefore, your profit is $1 in revenue. Now let's say that you added $1 in revenue. Your profit is $1, sorry. You added $1 in revenue, therefore you are now at $11 in revenue, which is exactly a 10% increase in revenue. Now, because you added that dollar and you're now making $11 in revenue, and your break even is still just $9, your operating profit also goes up $1. So therefore, your operating profit is now $2. Now that it raised by $1 where it was previously $1, so that is a 100% increase in operating profit. So because of these break-even, this should be break-even. Because of these break-even costs, these fixed costs, we basically know that even if our revenue goes up by a little bit, our operating profit will almost undoubtedly go up by more. Okay, so that explains degree of operating leverage in its entirety. So now let's try out a problem involving CVP.